It makes all the difference what rate you get on your money. And that's made all the difference in my life to take me from where I was to where I am today.
What is up, guys? Welcome to episode 003 of How to Invest in Commercial Real Estate. My name is Braden with the Criterion Fund. I am joined by my co-host Brian Duck with Criterion and Joel Thompson of Precision. What's up, guys? Thanks for coming on,
Braden.
So I thought today we'd dive into just comparing real estate returns versus other asset classes. You know, we're talking about why we think we should invest in real estate. We're going into, you know, how to find real estate deals, how to close on them. But I thought it would be a good episode to just stop and say, hey, here's what's out there. Here's how it historically performed, and here's what we're offering, and here's how that historically performed, and what that can really do for you over an extended period of time of, you know, your working life, which for ease, we'll just call that 40 years.
Yep. Well, I think we should go with Brian today because, Brian, you have been investing in the market and stocks and 401ks a lot longer than Braden and I have. So, you know, talk to us about your experience with the market and what do generally people expect on returns from different asset classes?
Yeah, I think stocks have probably got to be the most common investment by most investors. And as I looked into some statistics, you know, I think you can usually count on about maybe a 9% return on average. Goldman Sachs did a study where they looked at every 10-year period back for 50 years, and they found that the average for any 10-year period, the return on stocks is 9.2%.
Interesting. That's actually slightly higher than I would have thought.
Yeah. Well, I looked at some other time periods. So the S&P 500, if you go back from 2019, the end of 2019, you go back 20 years, the return for that period of time is only 5.9%. So I think that has a lot to do with the fact that the 2001 market was so bad, and then, of course, also back in 2008. So it captured those two periods. But what it says is that if you start investing, let's say you're working and you're raising, you know, kids and everything, you don't have a lot of money to invest, and you don't start investing till you're in your 40s or maybe later, and maybe you only have a 25 year period to invest. That doesn't guarantee you that you're going to get that 9% or something higher. There can be a couple of downturns that can really affect that return. So
that's interesting. I graduated college in 2001, started working and started maxing out my 401k in 2001. Is that why my returns have sucked? The last 20 years, I'm averaging 5% on my money.
Probably.
Okay.
The other aspect about that, and I'm just like this, is I don't feel like I can go pick stocks. So and I'm not sure I can even pick, you know, mutual funds and rely on those mutual fund investments. So I think a lot of people want a financial advisor, and most financial advisors are going to charge you on average about 1% of the assets they're holding in that account. And I looked into a statistic that said that if you had a financial advisor for a brokerage account or maybe a 401k, they used it as a 401k example, that if you invested the maximum amount that the government would let you invest in a 401k over the last 40 years, that 1% that the financial advisor is keeping costs you $1.3 million out of your account.
Wow.
Incredible.
That's insane.
So it's again, it's the power of compounding, but it's something people don't think about. So I've done that same thing. I have financial advisors, and I'm paying them, and it's because I just don't feel comfortable picking my own stocks or bonds or.
Yeah. So most people are paying fees funds for an actively managed account. How do those perform versus just an S&P index?
Yeah, I looked into that as well, and there's a guy named Phil Town. He's a well-known hedge fund manager, and he's also a best-selling author, and he's got a couple of books on the New York Times bestseller on investing.
Free plug for Phil Town.
Yeah, welcome, Phil. Anyway, he says that
that's funny.
The S&P 500 outpaces the returns of some of the more elite financial advisors. He looked at some of these guys that are managing really large funds, and the S&P 500 beats them 92.2% of the time. And again,
crazy.
It's not because these guys aren't smart. These guys are really smart and they're investing well, but it's their fees, he says, that keep them from being able to match the S&P 500 or beat the S&P 500.
Yeah, what it tells me is that they're not beating, on average, not beating the S&P by more than their fee.
Yeah, right.
And
that's
that's kind of been my thought is the stock market. I encourage everyone to invest in the stock market. It needs to be part of your investing portfolio. The problem is that stocks in general are sometimes, or most often, their only investment. The only thing they've ever done is put money into a 401k, and then it's pray and hope that there's enough in there when they retire that they can live the life that they want to live.
Yeah, and like Brian said, most people don't understand it. They need a financial advisor to help them, and it's charging them an exorbitant amount of money at the same time. And then on top of that, people are just forgetting about it. You know, if you're not focused on something all of the time and it's just in something you don't understand with somebody you don't know and don't talk to regularly, how do you think that's going to perform? Of course, it's probably going to underperform something you're thinking about all the time, every day, that you're in control of.
Mm-hmm. So, okay, let's talk then about, obviously there's a few higher return avenues that people can do, whether it's buying a business or investing in real estate. And so I want to do a thought experiment with everyone listening. If you have a piece of paper, write it down. But I'm going to take an average investment of $25,000 a year. So it's a little more than maxing out your 401k. It happens to be the lowest amount that we typically allow investors to come in with. But if you're in your 30s or 40s and have a good job, you might be able to put together $25,000 a year to put into an investment. So the question is this: how much do you have at the end of 40 years investing $25,000 a year at 8%?
Okay.
So mentally think about what you think that number might be. $25,000 a year compounded at 8% for 40 years. Because that's most people's working career.
So basically, if you max out your 401k through your job and then maybe get a tax return or save up a little extra cash through that, an extra $500 a month, you invest $25,000 and then you put it in the stock market, because that's what 9.2 and this is 8. So basically the same thing.
Yeah, about a stock market return, depending on how you allocate your portfolio. Okay, so you have that number hopefully in your head. Now I want you to do the same thing with a 16% compounded annual return.
So just double returns get me as excited as Charlie right there.
Yeah. So okay, so hopefully you got those two numbers. So I don't know. I'll ask you guys. You may not remember. But what do you think it is?
Well, I mean, foreshadowing, I was 9 figures off. 9.
Okay. Yeah, I remember asking you guys this question when I was thinking about it. So, well, we'll go ahead and pull up the graph for those watching on YouTube.
What's the number? It's 25,000.
25,000 a year times 40 years.
So times 40. 25. That's $1 million.
Okay, $1 million invested, so and if you. But it's invested at different times, right?
Right.
And it's compounded at 8% and compounded at 16%.
So it probably, over 40 years at 8%, it probably, I don't know, quadruples or something. Maybe at 8%, it's $4 million. I don't know.
Yeah,
I don't know what the answer is.
I missed it by 9.
And then at 16%, it's got to be.
All right, so we'll tell you. Hopefully, you guys will be shocked by this. But at 8, and we have it up. I think we have the graph up online. But at 8%. It ends up being almost $7 million.
Wow.
So 7 times your money.
Okay, so there's $1 million, an original money paid in. So you made about $6 million over 40 years at 8%.
Yep.
In the stock market.
Now here's what's going to blow your mind, or at least it did me. At 16%, the total after 40 years is just shy of $70 million.
Oh my gosh!
Wow.
$70 million if you invest that same $25,000. For 40 years at a higher interest rate. So the takeaway for me on this is that typically people are viewing commercial real estate as riskier than the stock market. And for one, anything can be risky without knowledge. I don't happen to think what I'm doing is riskier than the stock market. But
especially 10 times riskier.
Right. But then, so yes, that's the point is that, okay, they think, well, double the return, but maybe it's double as risky. Well, even if it was double as risky, now I want you to realize you're getting 10 times, or you have the opportunity to get 10 times the returns. Like the rate of return on your money in this life matters in a big way. And people, they see 8 and 10 and 8 and 16. They just see it, well, it's a little more interest. No, in your lifetime, it makes all the difference what rate you get on your money. And that's made all the difference in my life to take me from where I was to where I am today.
Man, I thought I was good at math, and I did this, and I felt like an idiot when I missed this so much, because it's so easy to say, yeah, 8% return, 16% return a year. We're going to do that for 40 years. Can't be that much. A little bit more than double. I was thinking maybe 2.5, 3 times.
Yeah,
which was generous, but I was missing it by so much.
If you averaged, now obviously it's hard to even in commercial real estate because you're getting money in and out of deals, so you're not going to be as consistent on your compounding. But at 20% return on that same $25,000 a year, it's $220 million in 40 years. So
crazy.
Let's
on the same $1 million paid in.
$1 million paid in is $220 million in 40 years compounded at 20%.
Oh my gosh.
So I know I can hear people saying, well, I can't, you can't even make 20%. Well, I'd like to look at a case study. And so we're going to pull it up online. It's a deal right here in town called Village South Retail Center. We purchased that 4 years ago. And as you can see from this pro forma that I gave the investors 4 years ago, and Brian, I think you're invested in this one. We were pitching about 12 to 13% cash on cash and a 22% IRR. What that means is that I told the investors that I was going to get them a 22% compounded return over the 5 years.
That's insane. That's a lot of money.
Yeah, I remember when you pitched that. I was thrilled with that.
Yeah, and
I mean, you're used to what, 9.2 stocks?
Yeah.
And so fast forward 4 years, we've paid out, we're paying currently 14% cash on cash, and we're going to up that this next year because the deal's going a lot better. But next year, we will be doing close to 25 or 30% cash on cash to the investors.
Wow.
With a third of the required equity in the savings account you mentioned before the show?
Yeah, we've been able to store up cash in the account. So that's a real life deal where I was pitching returns that people would say, oh, you can't do that. And not only are we doing it, and we're not, this is 4 years in now, but we're way exceeding it. Now, if you only have $25,000, you need to spread that out. And if you have, a bunch of money, buy a bunch of deals, because every commercial real estate deal isn't going to hit it out of the park.
Right.
You may have some make less. You may have some that make the returns that we think they're going to make. But this is an example. And we've had, Brian, how many would you say, you've been in all of our deals, how many would you say have overperformed what we projected to you at the beginning?
I'd say probably 75% of them. Don't you think?
Yeah, I would say most likely over half.
Yeah.
So, and I think the point I'm bringing this up is because people are listening, and the whole goal is to open their eyes to commercial real estate as being a vehicle for them.
Right.
And achieving things that they may not have thought were possible. Like in a previous podcast, we talked about this deal in Broken Arrow, Oklahoma, that you can find in front of a Walmart that can make 16, 17% returns. Yeah. Compounded returns while you have your money invested. And then I'm pitching you a deal here. It's in Tulsa. It's a shopping center. This is an average run-of-the-mill shopping center. It's in a good location. It's got good demographics, but here it's far exceeded even my aggressive returns that we had shown. So, man, I just don't think people realize the power of getting higher returns on their money versus what they've been getting in their 401k.
Yeah, or we talked about earlier the power of appreciation on scale, right? Economies of scale when it comes to appreciation in real estate. That deal you bought for what?
We paid $7.6 million.
Okay, $7.6 million, and total equity on that was
total equity 1.4 million raised.
1.4, and you're paying out 14-15%, and you think over the next few years you could almost double that cash on cash.
Yes, absolutely.
So that property's got to be worth way more than $7 million.
I would guess. I mean, today retail is a little tough, but I would guess 10 or 11 million pretty easily.
Wow, that's insane.
Yeah, that's great.
That's insane. So it's appreciated almost 50% in value, maybe more.
Yeah, and that is it's a little bit unique, but we have other. I mean, we've done even better than that in some apartment deals that we've done, but that's a good retail deal, obviously.
But it was looking at deals in your market. It was knowing that was a good deal. It was for sale for how long? I mean, did you fight other people for that deal? Did you push them off?
Okay, so that's a good point. That was for sale for a long time, and a lot of people had passed, and even I didn't take action on it. In fact, a real estate company here in town, way bigger than us, way more experienced than us, I called them about it, and they're like, no, we just can't make the numbers work. So just a good point that the deal of the decade is sitting sometimes right in front of you, and people with more experience or more money are passing on it, leaving it there for you. These guys were out of state. The original owners were out of state. They had passed away. It's now in the heirs of their children. They don't know Tulsa. They live in California. And the center had struggled in the past through the recession. And so they were kind of like, well, the numbers are moving up. This is a good time to get rid of it. Mm-hmm. And so their view of the value of their property was lower just because they had gone through the recession with this property, and they didn't have any affiliation with it. It was something their parents purchased. So those are the kind of things where opportunity is ripe for you to take advantage of.
So, what if you're saying or watching this or listening to this and saying, well, Joel, I don't want to quit my job. I don't want to go start a commercial real estate company yet. I don't want to go do this by myself or find the bank or find the investors. How would you get in on a deal like this if you were just working a regular job and investing in a 401k? How could you take advantage of that opportunity? Because it's a massive opportunity.
Yeah, there's a couple different ways. But if you're saying, well, if the only money they have is in a 401k, it depends on the type of 401k. If they have some self-directed capability built within the plan, then they can invest their tax-free 401k dollars directly into this as part of their portfolio.
Well, let's just say it's somebody in cash. Somebody's got $25,000 in cash, and they want to get it into a real estate deal that's making 20%. And the market's different than it was 4 years ago. But let's say somebody can travel back in time 4 years ago. They had $25,000. Can anybody just invest in this deal with you? Anybody could have just been on your email list at that time and gotten this opportunity and gotten those returns. How did Brian get the opportunity to invest in that?
Yeah, so Brian and all of our investors are on our newsletter. They're getting our emails so they can evaluate the deals for themselves. Depending on the type of offering that we do, that'll decide whether we can take a certain number of non-accredited investors. Before, you used to have to have 100% of accredited investors.
And Precision's doing Regulation D, 506C, or maybe not general solicitation because you're taking sophisticated investors.
Yeah, we have not done a general solicitation. All of our offerings to date have been needed to be accredited.
Gotcha.
And or sophisticated.
Gotcha.
Accredited is, I think, a net worth of $1 million, or they make over $200,000 a year, maybe.
Yeah, I think if you're married, it's $300,000 a year.
Okay, and then so now you can do a certain type of offering which allows sophisticated investors, which means that hey, if you have a relationship with them and they're reasonably educated and they know what they're getting themselves into, that you can take a certain number of non-accredited investors called sophisticated investors. I think what they want to protect is that we're not out pitching, shady real estate deals in a Walmart parking lot to people that may not know what they're getting into. But if you know us and if you're on our email list and we can talk through the risks and the rewards with you, then we can have a certain number of those in our deals.
Yeah, so I think there's a couple different people that might be watching the show or listening to the show. And I think one of those is going to be real estate entrepreneurs aspiring to go, build a real estate company and are going to be super interested to try to do this deal by themselves. And like we talked about in episode 2, fill up their email box with deal flow to try to find those deals. But I think there's also that other group that, said, hey, I don't want to quit my job. I just want to invest as, my $25,000 a year for 40 years, and I'll take that $250 million. They equally need to be filling their inbox with, signups like yours, going to Precision and signing up.
Other good sponsors. There's lots of sponsors that are doing all kinds of deals. So could be us, could be someone else.
You're filling, if you want to go do this by yourself, go find a bunch of deals and underwrite a bunch of deals. If you want to become an investor and invest in deals like these and reap the benefits without having to do all the work, because there's some work involved, then just fill your email box full of and real estate syndicators. There's tons of people that you can go sign up on their website for their investor list, and you get an email. Hey, we've got an investment offering. There's websites you can go to like Real Crowd and Crowd Street, and you can go in and say, hey, I'm an accredited investor looking for amazing real estate opportunities. Where can I get those?
And it may be the best way to learn about how to do this. Obviously, the goal of this is how to teach people how to invest in commercial real estate, whether that's a sponsor or an investor. But you may find that you learn a lot by getting in on a deal. That way you'll have access to the financials, you'll go through the closing process with us, and you'll get the updates, and so it'll help familiarize you with the inner workings of a deal.
It was a good way for me to learn how you go about analyzing deals and just all the steps. It was just by investing and trying to understand those steps, it helped me when it came time to start Criterion.
Well, hopefully we have enlightened people on the power of the size of your return and how much it matters, that extra few percent compounded over a bunch of years.
Yeah, and then equally associating the risk involved for that return. Like you're saying, most people think it's double the return, double the money, but it should be double the risk, right? But it's 10 times the money, and it's definitely not. It is definitely not 10 times riskier than the stock market. I promise you.
I actually, just being honest, with the money and the returns that I've made in real estate, starting from very little experience, I feel like the stock market is riskier.
I agree.
And that's why I put a majority of my money in commercial real estate, because not only do I feel that it's safer based on my experience, but the returns have proven that it's way better return, and I still feel that it's less risky. So I keep money in the market. I just don't, when I get a bunch of money, I want to put it back into real estate. I definitely don't run and put it in the market.
Right. Well, I think this is going to help a lot of people think bigger and really pay attention to those percentage points annually and the difference it makes when you compound them over your working life, which is about 40 years for most people.
Yeah.
Well, thanks for listening. Be sure to watch us on YouTube, like, subscribe, listen on Google Podcasts, Apple Podcasts, Spotify. Man, thanks for joining us.
Yeah, till next time.
Absolutely. howtoinvestincre.com. They've got the links to everything there, so feel free to go to the website, check it out. But Brian, Joel, we'll be back in a few days.
See you next time.
All right.